Let's jump right into this explainer because, look, we need to validate the sheer terror a lot of retail investors are feeling right now. If you're staring at your screen, feeling this deep sense of dread about long-term market suppression, you are absolutely not alone. The whole crying crypto monster vibe kind of sums up exactly how our portfolios are feeling today. But hey, before you let the panic completely take over, we're going to do what we always do. Tune out the noise and look at the actual data. So, here is our data-driven roadmap to calm those nerves. We're covering the anatomy of a bearish breakdown, what busted chart patterns actually are, the rising wedge bull trap, the macro PMI business cycle, and finally, the key long-term support levels we have to watch. All right, starting things off with Section 1, the anatomy of a bearish breakdown. We really have to start by looking squarely at the actual crime scene. We just saw this brutal 30% plummet below a beautifully structured, multi-year rising wedge pattern. I mean, we're talking about a trend line dating all the way back to 2021. When support that massive finally snaps to the downside, the bears are going to take a victory lap. And honestly, you can't even blame them. Why are they celebrating? Well, because the technical downside target of this specific breakdown points to a genuinely terrifying number: $20,000. For a lot of folks, seeing 20K screams, game over. But this is exactly where we need to take a deep breath, take an unemotional step back, and act like a veteran analyst. We've got to weigh this bearish trend against the actual historical and cyclical data. Which brings us to Section 2, Busted Chart Patterns Explained. Now this is where we shift from sheer anxiety to pure, unadulterated strategy. We're going to lean on a truly fascinating concept pioneered by veteran technical analyst Thomas Bolkowski. The goal here is to rely on strict, historically tested rules instead of our own market anxiety. Bolkowski's research provides some of the absolute most consistent, rules-based, and unemotional data you will find anywhere in the technical analysis wilderness. He's actually famous for identifying what happens when patterns flat out fail. This is what we call a busted chart pattern. So a busted pattern happens when the price breaks out in one direction, like our wedge breaking down, moves no more than 10%, and then abruptly and violently reverses into a completely new direction. Think about it. If a breakdown abruptly pivots like that, it becomes the ultimate bear trap for literally everyone who confidently bet on the drop. And this brilliantly illustrates a major veteran rule for crypto. Context matters. Bolkowski's original 10% rule was built pretty heavily around traditional equities. But because of the extreme face-melting volatility we see in the crypto space, a 30% downside wick, exactly like the one we just lived through, can still easily qualify as a busted pattern. Crypto moves with violence, right? So the leeway for these rules just has to be a bit wider. Moving to Section 3, the rising wedge bull trap. So now that we kind of grasp the busted patterns, why on earth should we blindly trust a downward breakout from a rising wedge in the first place? Well, we shouldn't. Bolkowski's historical data reveals a staggering 51% failure rate for rising wedges breaking to the downside. Let that sink in. More often than not, this specific downward breakout is a total fakeout. It draws the bears in, convinces the whole market the sky is falling, and then completely traps them. To put that into perspective for you, out of 36 recognized bearish technical patterns in chart analysis, this specific downward breakout from a rising wedge ranks as the absolute worst performing setup you could possibly trade. Literally the worst. And yet everyone is out there panicking over the least reliable bearish pattern in the entire playbook. Here's the kicker. Even in the minority of cases where these patterns actually do successfully break down, they typically only trigger a 10 to 20% correction. And since we already survived a massive 30% downside wick, the data strongly suggests the worst might already be over. False breakouts, like a sudden V recovery, are incredibly common in this setup. They're practically designed perfectly to trap those eager bears right before the real upward momentum resumes. Okay, going into Section 4, the PMI business cycle factor. To truly understand if we're caught in a bear trap, we've got to zoom out and look at the whole macro environment. Right now, there is a massive tug-of-war happening. On one side, you've got the bear thesis, which relies heavily on that broken trend line and the gloomy idea of a lower-for-longer traditional 4-year cycle. But on the flip side, the bull thesis points out that our busted pattern trap is perfectly aligning with an impending macroeconomic boom. And that macroeconomic boom, it hinges entirely on the PMI, or the Purchasing Managers Index. Historically speaking, the true parabolic crypto bull markets, the ones that literally melt faces, they only ever happen when the PMI business cycle crosses above 50, stepping into sustained expansion. The recent crypto highs, those actually happened during a period of contraction. But right now, we are just starting to test that magical expansion territory above 50. It's a total game changer.
Finally, Section 5, Key Long-Term Support Levels.
If we are actually going to confirm this busted pattern, there are specific battle lines the bulls absolutely must defend. Here is the veteran analyst watch list you need to memorize. First up, the 200-week moving average has got to hold strong down in that lower 60K range. Second, we are closely watching the short-term Fibonacci higher-low support, which is essentially just a healthy pullback zone sitting between $64,000 and $68,000. If we see some boring sideways consolidation in this zone while those supports hold, the bull trap is firmly in play, and the bears are going to get squeezed hard. So how does this all build into our ultimate upside scenario? Well, if the bulls manage to defend those key supports, reclaim momentum, and then push past the 50-week moving average, which is currently sitting way up near $95,000, it officially invalidates the entire breakdown. It busts the pattern completely and essentially confirms the start of a whole new market era. So as the macro PMI cycle expands and the outright worst-performing bearish pattern in technical analysis potentially busts right before our very eyes, it leaves us with one massive question. Are we just surviving the ultimate bear trap, or is this the actual launchpad for an unprecedented crypto supercycle? The data heavily suggests the trap is already set. The only question now is, who's going to get caught in it? Watch those support levels, stay analytical, and whatever you do, never let emotion dictate your strategy.